Hi, everyone. My name is Martha Serrano. I am the coordinator for the Money Management Center at Fresno State, and I really appreciate everybody logging in. We're really excited. We're really trying this time frame, and it seems to be pretty popular with what we're seeing right now with attendance. So thank you so much, everybody, for making some time after your long day in school, your responsibilities. But we have a great presentation today, and we're really excited to have Samuel Molina from Binational of Central California here today to present on investment planning. I know a lot of students have requested this topic, so we're really excited to have Samuel today. So again, everybody, we're recording the session. So in case anybody has to leave a little early, we will post it on our website, and I'll put it in the chat box for anybody to reference to. But if not, I'm going to go ahead and hand it over to you, Samuel, to start your presentation.
All right. Good evening, everyone, and thank you for jumping on today. Really glad to see so many participants, on this Zoom. And thank you, Martha, and the Money Management Group for having me present. Today, we're going to discuss investment planning. I'm going to share my slides here in a moment, but number one, feel free to ask questions throughout the presentations. I don't want you to forget your questions. Every now and then I will check in with Martha to review the questions that are in the chat. And as Martha mentioned, my name is Samuel Molina. I'm the Deputy Director of Binational of Central California. I have been investment licensed with the Series 7 SIE and S63 Life and Health licensed, and as well as I have a certificate in personal financial planning. I was a financial advisor with Northwestern Mutual for about 1.5 years, and then moved back into nonprofits where we've created this financial literacy department. All right, I like this slide here because, as it says, investment knowledge pays the best interest. All of you are going to school right now, right, to further your education, get a better salary, have a better lifestyle, just continue to grow your knowledge, right, because it will continue to pay off in the future.
Samuel?
Yes.
Just to interrupt, we're just seeing a black screen right now. We're not
You
seeing
are?
any of the slides.
What is going on here? Okay, so this is weird. You can't see this right here?
No, we're able to now.
Okay, it says my screen share is loading. Okay.
Yeah, it's working.
The purpose of this department is to create financially resilient and healthier families, to close the health wealth gap and provide greater generational wealth and reduce health disparities. So we do this by providing group presentations for businesses, organizations, right? We do one-on-one coachings, and we have online curriculum as well through the Federal Reserve. So if you have any questions, you want me to follow up with you, feel free to put your information, phone number, email in the chat, and I can follow up with you, and we can, again, provide these coachings for you to help you achieve financial success. I'm going to skip through these slides. These are part of a different presentation. And we're going to get straight into wealth accumulation and risk management, and then we'll dive into investment planning. So when it comes to savings, and you guys might want to write this down or take a screenshot if you'd like, but there are 4 time horizons in which every individual should be planning for, right? Number 1 is our emergency savings, right? Where we have 3 to 9 months saved up in our savings and checking accounts, our money market accounts, right? Money that we're keeping liquid and close by just in case we have something happen. 12 months max, right? Because we don't want our money to lose value, right? So again, 12 months max. Once we start looking for, trying to stay ahead of inflation, that's where we start investing money into mutual funds, exchange traded funds, or bonds, right? This is going to help us stay ahead of inflation. And as some of you may know, last year, inflation was at a 6.5% rate. Once we look at our goals 10 years plus, that's when we're going to look at permanent life insurance or real estate, right? To help with those goals. And then we have our long-term goals, right? 59.5. That's where we look at our 401ks or 403bs or SEP IRAs or Roth IRAs. These are retirement accounts. What you have to remember or realize is that with a 401k, the SEP IRA, 403b, is these are all pre-tax accounts. They're not going to get taxed today, but they will get taxed tomorrow. And with a Roth IRA gets taxed today and will not get taxed tomorrow, right? So it allows that income to grow tax-free. Now, one of the things, of course, everybody likes to think about saving and making money, but if you're not protecting that income, you're playing with fire. And some of the ways in which we protect that income, number one is life insurance, right? If you have a family or you're charitable, you know, somebody has to pay those bills if you pass away. So life insurance is number one, right? On average, a funeral may cost about $25,000. Disability insurance, we're all working, right? If once you become disabled, you still have bills to pay. So disability insurance kicks in if you're unable to go back to work, whether it's 6 months or 5 years, depending on how your plan is designed, they pay you while you're disabled, right? Long-term care insurance. Long-term care insurance, if you have a history in your family of Alzheimer's, dementia, Parkinson's, or ending up in a nursing facility, or even getting taken care of at home, long-term care insurance helps take care of those expenses, right? Homeowners insurance and renters insurance. If you live at home, if you own your own house, homeowners insurance is, you know, you have to have it. Renters insurance, I highly advise that you still have it. $12 to $15 a month with coverage as much as $100,000. Again, you want to make sure that you have these coverages in place, because if you have to pay out of pocket, the savings that you've been building up, the investments and the retirement that you've been building up is going to get drained relatively quickly. Martha, any questions right now?
No questions in the chat box.
Okay. Again, apologies. So now we're going to cover investments. I do want to make a disclaimer, share this disclaimer. Every person investor is unique and has their own objectives when investing. None of the advice provided in this presentation or on our one-on-one consultations is to be considered investment advice. Binational of Central California does not offer recommendations on stocks, investment portfolios, bonds, real estate, trusts, or other investment-related assets. The following information is purely for educational purposes and is not intended to be financial advice. So number one, some of you may work with an advisor, or you may be approached, you know, in the future by someone who wants to make recommendations. They do need to make sure that they are serving your best interest. So in 2019, under the Securities and Exchange Act, all brokers and dealers must act in your best interest at the time of recommendation, right? So if they're recommending a Roth account or a certain mutual fund, regulation best interest stipulates that they have to be serving in your best interest, right? And again, it's at the time of recommendation. On the other hand, some of you might have heard or will hear of what's called a fiduciary standard. And a fiduciary advisor is obligated to make recommendations that benefit you, right, at all times, whether it's insurance, tax planning, investments, so on and so forth. They have a fiduciary standard at all times, right, regardless if it's just investments. Now, when it comes to investment planning, it's important to know the 8 different asset classes that we have, right? We start with large cap stocks. These are, you know, companies like Tesla, Google, right, Microsoft, companies that have more than $10 billion of assets under management. Then we have our mid cap, right? Which may be about $3 billion to $10 billion. And then we have small cap, right? And the further we go down, you notice that the risk gets lower and lower. Then we have international emerging markets, international developing markets, where we start investing in different countries. Commodities, that's your oil, that's your gas, wheat, gold, silver, right? Fixed income, just like when you buy a share or a stock of a company, you own a piece of that company. When you buy a bond, you're buying the debt of that company, right? Or if you're buying a treasury bill, you're buying the debt of the government. And then you have real estate, right? Or real estate investment trusts. You're not buying individual houses, you're buying portions of houses, right, in real estate. It's important to note that when you start seeking out different mutual funds or exchange traded funds, that you understand what kind of investor you are, or if you're working with an advisor, that they understand what kind of investor you are, right? And so you need to make sure that if you're the kind of person who's panicking every time the market takes a dip, then maybe being a very aggressive investor is not your profile, right? Maybe you're taking a more conservative approach. So these 4 profiles, what you're taking a look at is somebody who's, conservative. They have a lot of money invested in fixed income, real estate. Those are our lower risk, right? Then we get into balanced, aggressive, and very aggressive, right? And you'll notice that there's more money being invested in large cap stocks, mid cap stocks, and small cap stocks. Okay. You always want to take into consideration, again, not only your personality, but your time horizon. Again, working with a financial advisor, they will help you determine that as well through a series of questions. Any questions right now? Okay. So you saw that in the previous slide, the different portfolios or allocations, depending on your personality, right? How well you are, or how concerned you might be with investing in your time horizon. One thing to note is what's called rebalancing. And rebalancing just means selling and buying the necessary securities to bring the value of each allocation in a portfolio back to the level established by the investment plan. So over time, your portfolio may become, the large cap or mid cap stocks may increase in value, right? And may take a larger share of the portfolio, whereas the bonds and the real estate maybe decreases, right? Moving out of these allocations. When you rebalance, you're moving it back into these allocations. And so there's a couple of advantages and disadvantages to rebalancing. Number one is rebalancing keeps investors' profiles aligned with the risk tolerance and need for a certain amount of return, right? It's a disciplined, unemotional investment approach that can reduce exposure to risk. However, some of the disadvantages is that every time you rebalance, there's additional transaction costs, right? Which may reduce the overall net income. Unnecessary rebalancing cost increases your cost, right? But it's important to be mindful of rebalancing because, last year, a lot of portfolios lost anywhere from 15 to 20%. And some people who maybe had a 40 or 50% allocation in large cap stock going into 2022, but their original allocation was maybe 32%, while they were losing a lot of money because they weren't paying attention to their portfolio, and what they really needed to do was rebalance again to get back down to that 32%, which was their original intention. So again, it's always important to pay attention to these things because sometimes you want to ride the wave when things are going well, but then you also want to be mindful of what's coming ahead and why rebalancing is going to be maybe appropriate for your portfolio. So there's several different key terms when it comes to investments, right? We have the bid and ask. So some of you may go on to, Robinhood or E-Trade to look at different stocks, right? We have the bid and ask. Investors are required to buy a market order at the current ask price, and they sell at the current bid price, right? We have earnings per share or EPS, which is calculated as a company's profit divided by the outstanding shares of its common stock. This results in the resulting number serves as an indicator of a company's profitability. Then we have outstanding shares, right? This refers to a company's stock currently held by all of its shareholders, including share blocks, held by institutional investors, and restricted shares owned by the company's officers and insiders. We have market capitalization, dividend, and beta, right? When it comes to dividends, if you own a share of AT&T or IBM, it's important to note that not every company pays you dividends, right? But some do, and it's kind of a reward for owning their stock. So for example, if you buy one share of AT&T, they may say, hey, we're going to pay you, 20 cents a share for every share that you own. And we're going to pay that to you quarterly, right? Well, what you can do with that 20 cents or whatever it amounts to is you can actually use that money to reinvest into the company, or you can take that money out as cash and use it for whatever means necessary. When we took a look at the beta defined as the measure systematic risk. It's a suitable measure of risk for fully diversified portfolios. And what I like to share with folks as an example is the S&P 500 has a beta of 1, and so does the overall stock market. And sometimes what you might see on a established company is you'll see a beta number. And you might see that it says, a beta of 1.5 or a beta of 5, right? What that means is if it's above 1, the riskier that stock is. So if it's a beta of 1.5, when things are going bad, that company is going to do 150% worse than the overall market. But if things are going well, then that company is going to do 150% better than the overall market, right? So again, the higher it is away from 1, the riskier it becomes. If it's below 1, then we have less risk associated with that company. Any questions? No questions? Okay, we'll continue moving on. Again, when you speak with a financial advisor, right, or even if you're not, there should be a series of questions that they're going to ask you, but there's something that you need to be asking yourself, right? What are the goals and purpose of the investments, right? How much time do you have to invest? When will you start using the funds? And risk tolerance, right? Are you conservative? Are you aggressive? Are you comfortable with risk? These are things that you should be asking yourself, right? If you're retirement planning, 20, 30 years down the road, you might be very aggressive because you can deal with the ebbs and flows of the market. But if you're coming closer to retirement, 5, 10 years down the road, you're probably not going to be as aggressive an investor, right? Or let's say you're trying to buy a home and you have an investment account and the plan is to buy the home in 5 or 6 years. Again, be mindful of how aggressive or how balanced your portfolio is. All right. So since I can't see you all, I don't know who's participating. We're going to do a little bit of an exercise called dollar cost averaging, right? And for those of you who have your phone out or if you have a calculator nearby, what I'm going to ask you to do is choose one of the columns, either the blue column, the green, or the red column. And you're going to total up all of the numbers in either column that you choose and then divide it by 4. So let's look at what dollar cost averaging, what does it mean, right? Well, it involves investing the same amount of money in a target security at regular intervals over a certain period, regardless of price. By using dollar cost averaging, investors may lower their average cost per share and reduce the impact of volatility on portfolios. So in other words, if you're trying to time the market, you're likely going to pay more than if you were just making more frequent contributions, maybe on a monthly basis or quarterly basis. So again, I'm going to give you guys about 30 seconds. Add up column blue, green, or red. Divide it by 4, and then feel free to put in the chat box what answer you get. Just put, column red and then the answer. Thank you, Genevieve. Thank you, Jose. Celeste, looks like a lot of people chose red. All right, Celia. All right, anybody want to do column green? All right, nobody for column green. So dollar cost averaging. if you take a look, we do 12 months on average, right? You'll notice that we pay $18.54 a share, and we'll get a total of 323 shares, right? So this is assuming that I'm putting $500 away every month, a total of $6,000 a year. For those of you who did the columns, this is assuming you're putting $1,500 a quarter, right? So in column blue, $18.32. Number of shares is 327 shares. So you have actually gotten more shares and paid less than I would have at putting $500 a month. However, in column green, we have $18.63 a share. So now you're paying more than me and you're going to get less shares. And quarter three, the red column at $18.66, 321 shares. So again, all this to say, if you're increasing your frequency, on average, you're likely going to pay less than if you're trying to time the market, right? Even if all you're putting away is $25, $50, or $100 a month, every month into your investment account, it's better than trying to save $500 and then time it, and you're likely going to pay a higher cost. Any questions on any of this? Right. So for those of you who may have retirement accounts or considering investing, there are a few different types of funds. There's more than what I'm just sharing today. We have mutual funds, right? A mutual fund is a managed fund that pulls from shareholders to invest in securities. Those can be bonds, money market accounts, again, stocks. They're operated by professional money managers, so it's actively managed, right? They do have annual fees, expense ratios, or commissions, which affects your overall return, right? When you're buying an individual stock, AT&T, IBM, Google, Tesla, what you have to remember is that when you're buying these individual stocks, there's a transaction fee associated with every single one, which obviously increases your cost. When you buy mutual funds, you're buying multiple stocks of different companies. It's a great way to diversify your portfolio, and you're lowering those transaction costs, right? Mutual funds and exchange traded funds work very similarly, right? Again, diversification. However, an ETF may be passive or active, right? You may have a professional money manager following the ETF, or you may not, right? When you have a passive exchange traded fund, it's typically going to cost you less, right? Because you don't have somebody actively managing that account. With a target date fund, what's important to know about these, and a lot of people have these in their retirement accounts, like their 401ks through work. All that really means is that as you're getting closer towards that date, it's going to shift from an aggressive portfolio to a more conservative portfolio over time. So if your retirement, your target date fund says, 2055, it's going to start off aggressive, obviously, in 2023. And then as it gets closer to 2055, it's going to become more conservative on its own. So that's the way it's designed to work, right? I'm going to leave my screen on here so you guys can take notes or ask questions. Anybody have any questions on this? Target date funds, exchange traded funds. All right, so it's 5:25. That is actually my presentation on investments. So I'd love to answer any questions folks have on how investments plays into your overall, again, financial planning strategy, or I can go back over any other slides that we have. If nobody has a question for me, I have a question for you all. What did you guys find most valuable about today's conversation? If anybody wants to put something in the chat. Genevieve, so recommendations for financial advisors. I usually refer folks to my financial advisor. You know, Northwestern Mutual was the company that I used to work with. Although they are primarily an insurance company, their advisors also do recommend investments and can manage those investment accounts for you. There's also places like Edward Jones, you know, that you can look at, or Fisher Investments, right? But before you begin investing, I would always advise, make sure that you have an emergency fund built up, at least 2 to 3 months. Because if you start investing and you need money and you have to pull from that investment account, you're going to have fees, maybe some capital gains taxes associated with it, which could put you in the negative, right, and cause you to lose money. So always have that 2 to 3 months of emergency savings. Then I would recommend, you know, advise, start looking at investment accounts. Anybody else want me to cover something else? How much would you recommend? I'm sorry, I can't pronounce your name. But how much would you recommend for emergency savings? So if you have, you know, at a minimum 3 months of emergency savings, and let's say your monthly bills are, you know, $3,000, then you should have a minimum of $9,000 in your savings account, right? Maximum would be 36,000. But again, we want to keep money ahead of inflation, so maybe 9 months. I also want to mention, you know, in 2008, during the recession happened, a lot of people were out of jobs for more than a year. And during the pandemic, a lot of people lost jobs too. And on average, it may take you 6 months to find another job. So ideally, you're going to have 6 to 9 months worth of emergency savings. But that doesn't mean, you know, wait to start investing. But I would say at a minimum, have 2 to 3 months. I hope that clarified things. Mendoza, did that answer your question? Great. Any other questions? Again, if you want me to follow up with you, feel free to put your name and contact information in the chat box. You can send it to me directly. Love to help you, again, plan for the future.
We don't see any more questions, Samuel. So thank you so much for your time today and everybody for coming to today's webinar. Again, we'll start the recording right now, but it will be posted on our website probably early next week. But we thank you again for your time.
Sorry, 1 second. Somebody put their information in the chat.
Okay.